Hello and welcome. You're watching us here on Trading Hour, coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangalam Malu. With me, Hormaz Fatakia. Ritu Singh as well joins in. Looking good for the market today after a few days of decline. Yesterday, there was a bit of a jostle. The Nifty managed to hold on to the 50-day moving average. And today, lo and behold, after good support coming in from Wall Street, the Nifty has moved higher. It's been led by IT stocks, by Reliance, and the broader markets as well. The advanced decline tells you that after 3 days of over 1,800 stocks declining as against 700-800 stocks which would gain, now that has flipped. The green line is much above the red one with about 1,900 stocks in the green for about 900 in the red. Ritu, looks like a good Christmas for bulls.
It does. We have to see if there will be a Santa rally, though. But it's good to see green back on the screen after what's been a pretty volatile week. But Nifty still has to close, a little above 26,046 odd mark to end the week positively. So that's the cue I'm going to be watching out for. But yes, positive cues globally, from the Wall Street, of course, the big international event, the Bank of Japan rate hike, that is now behind us. And domestically, a lot of individual movers with, the Ola Electric news. We've seen promoter stake sale now ending, ICICI approve a new listing. And of course, the big one, Shriram Finance's board meet, where we'll be watching out for a big deal announcement with MUFG. So lots of cues, for traders today. But I'll toss it to Hormaz for the top movers.
Well, the broader markets are doing well for themselves as well today, as the broader markets are looking to end the week on a high. We'll start off with some names such as Aeroflex Industries, and that's a news flow driven move. The stock is slightly off the highs of the day, still holding on to gains of around 10%. The biggest single day gain since January. We have had more than 55 lakh shares that have already been traded on the stock. The 20-day average is just about a lakh, and the stock has been trading above all of its key moving averages and has done well. It's a recent listing is Aeroflex Industries. Is up almost 85% from its issue price of 108 rupees. JK Tyre has snapped a 3-day losing streak today. The volumes are the highest in nearly 2 months for this 6% up move that the stock is seeing. 20 lakh shares have been traded here. The 20-day average is around 3 lakh shares, so around about 6.5 to 7 times its 20-day average are today's volumes already in the first couple of hours of the trading session. Since the end of August, the stock has remained above all of its key moving averages, and it continues to sustain above those levels. It is the 4th straight month of gains that the stock has seen this year, and it is up 25% on a year-to-date basis. And lastly, Quadrant Future Tech is the top gainer on the small cap index today, 15% higher on the stock. Snapped a 3-day losing streak here as well. Volumes are the highest in 2 months, the biggest single day gain that the stock has seen since the month of March. And take a look at the volumes here. 54 lakh shares have been traded on Quadrant Future Tech compared to a 20-day average of just 1 lakh shares. So gaining on very, very strong volumes. The stock, though, remains below its key moving averages. And from its post-listing high that it made, which was around close to 750 rupees, the stock is down almost 65% from those levels. And it is one of those IPOs that saw very heavy subscription, a very heavy listing. The retail portion was subscribed almost 250 times. And now the stock has come off significantly from those highs.
All right, Hormaz, thanks very much for taking us through that. But let's get back to the big global story. The Bank of Japan hiking rates by 25 basis points today, the first hike since January and the highest levels that we've seen in the last 3 decades. Benjamin Cavender, who's the managing director and head of strategy, China Market Research, joins us now to decode this for us. Benjamin, thanks very much for your time here. The hike was pretty much along expected lines. There was no surprises there. But what do you make of the commentary that has come in since? Does it look like more normalization may be ahead? And the yen hasn't reacted the way the markets perhaps expected. Do you expect to see more of that, sort of move, perhaps once the news settles down, we hear more on the forward-looking statements?
Yeah, I think this is an interesting situation because this is sort of, new territory for the Bank of Japan, given how careful they've been with interest rates over the last few years. I think this rate hike was expected. People have been worried about consumer inflation in Japan for a couple of years now, and I think this is reflective of the fact that they're trying to do something about that. My guess is the reason why we haven't seen more movement with the yen so far is to some level, investors have kind of priced in this move already. As the news settles, maybe we'll see some changes. I also wouldn't be surprised if we see possibly another rate hike sometime early next year as well, when this doesn't have maybe the desired effect on controlling inflation that they'd like it to have.
But Benjamin, from a fund flow standpoint from here on now, with rates being at 30-year highs, where does it leave the equity investors? And, even going ahead, are you expecting any sort of imbalances in that yen carry trade now that we're finally starting to see these hikes materialize?
I think there are still, frankly speaking, good opportunities for equity investors into Japanese companies and Japanese exchanges. The economy is fairly strong. I think that's why you're having this rate hike discussion today. I think where there's some risk is that the government has been relying very heavily on borrowing to fund infrastructure projects, public works projects, and this is going to make it a little bit harder for the government to borrow and pay off debt to maybe the level that they wanted to. And so I think the downside risk here is that the economy actually stalls out a little bit because of this, but I think we're probably okay.
All right, we're okay there. Benjamin, good to speak to you. Just wanted to understand your outlook on the Indian economy, and as a result of which the Indian stock markets, given its underperformance versus the developed space in the last 1 year.
Yeah, I mean, I to be fair, I don't follow the Indian markets as closely as I should. The sense I have right now is that maybe a lot of investor money has tried to sort of focus on mature markets and the U.S. market over the last few months, just because it's sort of been seen as a bellwether economy, with India, as an emerging market being maybe slightly more risky. Having said that, I think there's a tremendous amount of upside for Indian markets going forward. And if I were advising international investors on capital allocation right now, I'd probably be saying take a very close look at India, given the kind of economic growth we're seeing right now. So I'm pretty bullish, frankly, on Indian markets.
Getting back to Japan, Benjamin, what happens to the yen from here on? There has been enough and more chatter over a possible intervention from the Bank of Japan if it goes down to levels of 160 odd. Do you see that happening? And more so, because you mentioned that the country has been very reliant on borrowings. Now, what happens after this rate hike? Does the programs get affected? Do you believe that the spending, the fiscally light government that the country currently has, that might have to take a backseat?
Yeah, I mean, I think in terms of yen values, there is concern about the yen dropping too much further. And I think we'll probably continue to see further support for the yen if it's moving in the wrong direction. I think the fear right now is that inflation and costs are essentially being passed on to consumers and companies as the yen weakens, and there hasn't been enough support to kind of prevent that. So that's why I think it's possible we see more interest rate hikes in the future. Now, having said that, I think if you look at what the Bank of Japan is doing versus what the Prime Minister wants, they're kind of a little bit diametrically opposed. I think the Prime Minister wants to be able to continue borrowing aggressively, wants to be able to tout sort of economic growth at all costs. And typically that means low interest rates. So I think we might frankly see a little bit of friction on policy going forward if there's a push to sort of maybe force the government to rein in spending. But it remains to be seen how that plays out.
Benjamin, finally, 155.93 is where we have the yen now. What sort of moves are you expecting in 2026? Is the market telling us otherwise? Typically, with a rate hike, you would expect the currencies to strengthen, which has not been the case.
Yeah, I think this rate hike in and of itself was probably not enough. I think if we see another rate hike of 25 basis points to get us to 1%, that will start having an effect. And I suspect that probably that's the direction we're heading in. And so I think that's where you'll see the yen maybe firming up a little bit and starting to move, maybe more towards 150 versus down towards 160.
Benjamin, pleasure having you today. Thank you so much for sparing time and joining us on this big global event for the morning. The Bank of Japan raising interest rates to the highest level since 1995. Take a short break. On to the other side, back to our own markets. A corporate conversation. The management of Borosil Renewables joins in on the other side.
Welcome back. The broader market seems to be selling off. A couple of these names are coming in for some unwinding of long positions. So HDFC, AMC, Nippon Life India, Nuvama Wealth, all these capital market plays were doing extremely well. But right now we are seeing a bit of a profit booking post the up move that we saw in the previous few trading sessions, or maybe just a bit of nerves settling after the SEBI TER guidelines have come by. There are some lines coming at the bottom of your screen. This is with regards to the Interglobe Aviation case, where the Delhi High Court has sought Customs Department response to Indigo plea of over 900 crore worth refund. So we'll get more on that in just a bit. But let's get chatting with the management of Borosil Renewables. Pradeep Kumar Kheruka, who's the executive chairman, joins us now. Thanks a lot, Mr. Kheruka, for joining in. It's an interesting time where you join us in because, one, the government has extended the tenure of countervailing duty on imports of solar glass from Malaysia until June 8th, 2026. So that's a positive for the industry because there was, this demand before the sunset clause comes in. And the second part is that the Ministry of New and Renewable Energy has issued an advisory urging banks to be cautious and take a calibrated approach to financing additional standalone solar module manufacturing because they believe that there is overcapacity on that one and there are risks of NPAs. Instead, they say that go ahead and look at upstream components like polysilicon, ingots, wafers and solar glasses. You stand to benefit from that as well.
Yes, of course. You see, the thing is that we are on the ground. We sell solar glass to module makers and we know exactly what is happening in the market better than I think most other people do. So, for instance, solar glass capacity in the country today is 1,600 tons per day, approximately. And the imports of solar glass in the country for the last few months have been running at a rate of 8,000 tons per day. 8,000 tons per day with a domestic manufacturing of 1,600 only. So we expect that all capacities which have been announced and which are actually under implementation, construction now, are going to be snapped up from the moment they are available in the market. I have no doubt about that. And therefore, as far as solar glass itself is concerned, the demand scenario is very, very bright. Now, we are coming up with another 600 tons of production ourselves, which would translate to about 450 tons of saleable glass. So 600 tons is the tons per day melted. And we have 600, so 450 tons is nothing. It's a drop in the bucket compared to the actual demand. And then Vishakha is coming up and many other people are coming up. So all the solar glass coming up is definitely going to be consumed. Coming to the question of the advisory by MNRE, there was an initial statement and then there was a second statement which was diluted somewhat because what is also visible on the ground is that the offtake of solar panels is going much beyond the grid, going much more beyond what the government is ordering. And I see a lot of panels going into captive power by industries for rooftops. And people have just discovered that solar power is a reality. They can use it, and if they put it on rooftops, they are able to save money, and they have some certainty of power in case of power failure and so on. And as I see that we're going to be progressing to batteries also, a widespread usage of batteries, I can see that very comfortably on the horizon. And the other things like aluminum frames and polysilicon, we don't have any at all in the country. So there's a large amount of value chain which is feeding into solar modules, for which there's a very robust demand and very bright future, given the government's support for this industry.
Mr. Kheruka, thank you for joining in. Two-part questions. First one being that before the duty was imposed, what was the quantum of imports that were coming in from Malaysia? And part two is what proportion of your current volumes are linked to those customers who were earlier dependent on such imports?
So actually, Malaysian imports had ground to a standstill until the basic customs duty was announced on the imports of solar glass from China. It's only after solar glass imports were allowed from China that Malaysia ramped up in a very big way, and it's pretty large right now. The impact of this extension of duty is essentially that there was a sunset review which has been undertaken and which is currently in progress by the Director General of Trade Remedies. And they're taking some time to complete that. In order for there not to be a break, they extended the validity of the countervailing duty by 3 months. And I believe that they expect to be done with their investigation within this period and make their recommendations to Ministry of Finance. And based on whatever that might be, we will see something new happening, hopefully before the 8th of June. So that is the expectation. The importance that I read into this is that the seriousness with which the government is addressing the Indian industry and overall, that means the module manufacturing and the component manufacturing is very serious, and they're intending to make sure that Indian industry gets its proper place in this one.
Mr. Kheruka, you've reported about 33% margins in the second quarter, and your guidance is also to be able to continue delivering this kind of a margin. We wanted to understand how much of this is really baking in the duty protection, and if that goes away, how much demand-led pricing, operating leverage do you have to sustain and improve on those levels? And also, what investors really want is clarity beyond June 2026. Do you expect the duty to be extended further?
You see, I want to get one thing clear here for everybody, especially investors. For every 1,000 crores of money invested in solar glass manufacturing, the amount which is actually available is about the sales are 600 crores. So therefore, to pay for interest and depreciation on 1,000 crores from sales of 600 crores, we need a very high margin. So 30% margin is standard for this kind of output, and therefore 33% is not that high as it might appear on the face of it. And I would say that the balance of selling price and margins is just about right. And I do not see that the government is going to do anything about changing the structure of duty, which is currently in place anytime in the near future.
All right. Mr. Kheruka, just before we let you go, if you could give us a sense on what the prices are right now, because I remember the last conversation that we had, the prices were close to around 55,000 rupees per ton. Have we seen an increase thereafter? Secondly, on Europe, you were losing about 800 to 1,000 euros every month there. Has production resumed? Are you seeing improvement? And the third part, volumes. So on prices, Europe and volumes.
On prices, we are now selling our glass at about equivalent to the minimum import price, or maybe a little bit more. And volumes, of course, we are selling everything that we can make. We are doing our best to maximize production, so we do not see any problem there. And we are running quite well. We are running at about 100% of capacity. We're running at about 990 tons per day as an average. And we are trying to see if we can improve that. So
the minimum import price is close to what? $650 to $677 per ton? Is that what?
Right. About $646 per ton is the minimum import price. So depending on so there's a different price from Vietnam, different price from China. So there's our selling price falls somewhere in between these prices, and we are able to realize those prices, and we have no difficulty in selling it. There's ready demand for our production.
So that's about 55,250 rupees thereabouts per ton basis in a rupee term. Thank you so much for joining in and giving us your view on the sector, and at the same time an outlook on what life looks like 2026 and beyond. Wish you a happy festive season and also a happy 2026.
Thank you very much.
With that, we take a short break. Come back on the other side. We have the Bond Street. Manisha speaks with Aditya Birla Sun Life AMC's Bala in our special segment.
India Bonds presents Bond Street.
On Bond Street today, we are joined by a very special guest. We have with us A. Balasubramaniam. He's Managing Director and CEO at Aditya Birla Sun Life Asset Management Company. Bala, hi, thank you so much for joining in. And you've been in fixed income asset as an asset class for a very, very long time, couple of decades or more. And how have you seen bonds or debt market gain in popularity during these years?
Yeah, thank you, Manisha, for having me part of the show. Of course, I've been associated with the bond market since 1992. Immediately after the Harshmata scam, I got into the bond market as money market trader. Then I was a portfolio manager for almost about a decade before I became an equity manager as well. But I'm associated with the bond market 92 since the time the reform period on interest rates, where interest rates were freed and then made it more market-driven kind of interest rates.
So you've lived the bond market journey.
I've lived the entire bond market. I've also seen issuance of bond market at as high as about 25%, where G capital kind of companies who had created a presence in India way back in the 90s had borrowed in India at a very high cost, about 25%, with backstop facility coming from their parent company in the US. Even like Kotak Mahindra Finance in those days used to issue bonds about 17.5 to 18%. So I've lived through that period, and moving away from that to a holistic investor across the yield curve, right from money market instruments to the corporate bond and government securities, central government securities to the state government securities. I have seen the entire cycle with interest rates touching as low as about 5%, interest rate touching as high as about 11.5 to 13%. So I have seen large coupons, which used to be the biggest savior for us as a bond market investor. Higher the coupon, higher the protection for you. Lower the coupon, lower the protection for you from an accrual point of view.
Right.
I've seen this cycle, how it got evolved, how it got developed. But as time progressed, the more and more market became transparent. The money that is available for investing in the bond market through the mutual funds and more players coming in, it has only got more and more vibrant and bigger. Of course, one has to still keep in mind the bigger bond market issuers in the country is Government of India. Next is the state government issuance of bonds. Then third is the public sector companies, and then fourth is the private sectors and corporates and NBFCs. If you look at that bucket,
right,
and mix between money market instruments to the long-term bond issuances. Even the banks themselves most of the time issue bonds by way of infrastructure bond, by way of CDs for 1 year money market instruments. They also issue AT1 bonds. Therefore, they only got developed over a period of time. My belief is it's a large market. And in fact, being part of the bond market, I have seen complete evolution of the bond market in terms of becoming one of the biggest investment vehicle for all of us as a money manager.
So fast forward to 2025, and the last couple of years haven't been so great, but 25 really seems to be changing that. And would you say 26 perhaps could be even better? So if you had to look at the next 4 and 5 years, especially with OBPs now becoming a bigger part, retail perhaps is being pulled in as well, how would you look at India in 2026 and the next 5 years?
I think it can only get better because we are all involved in the bond market development since the 1990s. And every time we used to always think that we keep discussing, but nothing much is happening. But if you look at the progress, like OBP platform that you mentioned about, is a platform created by the industry players to get more and more participation, to see the prices, to the yields, to the prices, to the issuance, to the outstanding, to the volume. With all of us as a mutual fund players and other institutions now reporting the transactions on the OBP platform, definitely the data that is available for one to know better on the bond market is increasing. This will actually create more and more awareness. And second is the SEBI regulated entities like RFQ platform, which has created more for increasing the more trading data points for the bond market players. I think these evaluations will only make it more better. And last but not the least is so far, the last 2-3 years, most of the companies actually who need more capital for growing the business, they always used to debate between equity growth capital versus the bond market. The last 3-4 years the journey has been much better for most of the people for raising money to the equity market. I'm sure the time will come, but they have to come to the bond market for funding their growth. So therefore, the next 4-5 years, if you take, I think after some time people start saying, why should I actually share my wealth beyond a point by way of issuance of equity?
Right.
They will always switch towards the bond market.
And do you see that happening? Do you see that?
I see that happening. Second is actually if I'm net worth is say X amount, but through the bond market, I can go up to 1.5 times of bond market issuance, which is basically the debt equity. If I have to take close to about 1.5 times leverage, I can do. The multiplier effect of that could come for the investors, ROE, the more the growth I build through the bond issuances,
More people
my ROE is better for shareholders' point of view. I think that's what most people start looking at it. I think time will come where companies will start realizing, probably if I fund my growth through the bond market, where the cost of capital today is the lowest, and therefore funding through the debt would become more cheaper than funding through the equity, both from a shareholders' value creation point of view, as well as the money multiplier effect point of view. Therefore, next 4 or 5 years, I would assume the issuance of bonds will increase. Of course, Government of India has also done a great job of bringing on the fiscal deficit. Therefore, the more and more issuance of government bonds comes down, more and more room will be available for private issuances to come in, which is what I feel the next 4 or 5 years we'll see. Bond market issuances keeps rising, and that's something would be more ideal, even for any investors to look at that, not ignore that segment. The reason is the return there you see is real, you see it, coupon coming in month on month with an annual basis. Therefore, that's something should not be ignored from a broader perspective.
CNBC-TV18 and India Bonds presents Bond Street.
Welcome back. You're watching Trading Hour. Now, one of the key stocks in focus today we've been talking about is Shriram Finance. Pull up that stock about up. It's up 47% this year. I think 32% in just the last 6 months. Now, of course, trading at 863 kind of levels, down about 5 rupees in trade today. But, the stock has been running up on the back of this expected announcement where the board is meeting today to mull a fundraise among, widely reported, suggestions that Japan's MUFG could pick up a significant stake in the company. Gaurav joins us to tell us more. Gaurav, 20% stake by MUFG, perhaps including 10% in the holding company. We'll have to see how that structure pans out, but tell us what to watch out for.
Well, yes, Shriram Finance, we can call it as one of the most speculated stock for the day. And the reason being that today is a day where board is going to hold meeting to consider fundraising. Now, why this is important is that in the last few days, we have already seen media reports which suggested that Japanese firm MUFG is looking to buy around 20% stake in the company. Even the latest report suggests that the valuation that they're looking for is anywhere between 4 to 4.5 billion. Now, this will make it as the biggest investment in the financial segment in this year so far. But at the same time, even if you look at the numbers, understanding the structure is a key thing to watch out for, because if we go with the higher end of the number of $4.5 billion and if we calculate the 20% stake, implied value per share could be anywhere between 850 to 860 per piece, in line with what the current market price is. Apart from that, if you look at the stock and specifically Shriram Finance, this capital will be seen as a strategic investment and not as a capital which is required by the company, because if you look at the capital adequacy ratio, it is already at 20%, given that they are targeting around 17% growth for this year and they also have enough debt and equity in the company. It does not look like they need fresh capital. It is going to be a strategic investment which will bring down the cost of fund for the company. So definitely it will be positive for the company if this deal comes through. When it comes to valuations as well, even after the rally that we have seen in Shriram Finance, it currently trades at 2.2 times price to book if we compare it with FY27 earnings, which is still lower than the closest peer that they have, which trades somewhere around 4 to 4.1 times price to book. And lastly, even if you look at the 14-day average price for Shriram Finance, it comes anywhere between 846 rupees a piece. So that is also something that we should be watching out for. But we will be watching out on how the commentary is coming from the management on this deal.
We'll keep an eye out on that. Gaurav, thank you for setting us up for the big announcement from Shriram Finance later in the day. Just before we take that break, pull up Grow. And it's a very, very sharp spike that you have seen in just the last few minutes on the stock. It is up around 11% now as we speak, past the 160 mark again is Grow. And it was a brokerage initiation that came in earlier in the day. Jefferies initiated coverage, the target of 180 rupees. And there you can see the spike on Grow, 11% higher on the stock at 160. Take a short break. Sunny Agrawal of SBI Securities joins in on the other side to talk more on the markets. Welcome back. Sunny Agarwal from SBI Securities now joins in to take the market conversation forward. Sunny, good morning. Thank you for joining in. One of your preferred ideas has been the auto ancillary space. There's been a lot of chatter about the auto sector. But what about the auto ancillaries? What makes you so bullish on this?
Yeah, good morning and thanks for having me on the show. I think, yes, definitely. I think post GST rationalization, we have seen that there has been a strong uptick in volumes across the auto subsector, whether it is passenger vehicle, two-wheeler, three-wheeler, or for that matter, commercial vehicle or tractor. Although commercial vehicle and tractor seems to be better placed when we talk about second half of FY26, wherein first half was not so good for this space, but looks like second half will be a very robust in terms of volume delivery. And we believe ultimately the best way to write this story is through auto ancillary companies, because auto ancillary company has got an added advantage in form of wherein they cater to a domestic OEM. At the same time, we have seen that many international players are making India as an export hub. So that is something which is giving them another leg up in terms of growth. And moreover, most of the auto ancillary companies, if you look at, they have diversified in terms of product offering, either by growing organically, inorganically, or tying up with an international player. So I think the valuation at which the auto ancillary space is sitting, it seems that most of the companies in the range of 5,000 to 15,000 market cap band are well placed to deliver kind of 20-25% earning CAGR over the period of next 2-3 years.
Right. I'd like your thoughts on a couple of these tire companies. Since you're speaking about auto ancillaries, what are your views on tire companies? Because all of them are doing extremely well today. JK Tire is up 7%. Seat is higher. We've seen some traction build up in Apollo tires as well. Crude prices are lower. And if auto sector is likely to do well, tires are beneficiaries. And they're also, platform agnostic. You could be driving an ICE or you could be driving an EV. Tires will be required for both?
Yeah, definitely. I agree with you, Mangalam. And one more thing, apart from all the points which you have discussed, is that we have seen of late there is a stability in the rubber prices, and whatever the price action most of the tire company has to take, that has been taken care of during the first half of FY26. Seems like tire companies are very well placed to deliver a healthy earning growth. As you rightly pointed out, with the benign crude oil prices, the carbon black, which is one of the key input material, there also the companies are likely to be one of the key beneficiary. And at the same time, as historically we have seen, as the auto sales volume pick up, ultimately the OEM demand obviously is likely to do well. Going forward, replacement demand also tend to do well. So we believe among the tire play, Seat, which is more of an two-wheeler or passenger vehicle and with a strong brand presence, Seat is one of the stock which we are recommending to our clients.
Sunny, in the NBFC pack, you've picked Shriram Finance as one of your top picks. But, on the back of this anticipated news, the stock has also been running up. I mean, from the start of the year, 600 levels, we've gone to 860, 862. How much of an upside do you see from here for new investors to enter? What sort of an upside is there if the deal materializes?
Yeah, as you rightly pointed out, that definitely we have seen a strong run-up in Shriram Finance over the period of last 1 or 2 months on the back of the deal, which is likely to get announced today. But what we feel is that ultimately a long-term growth story is still intact, although trading at closer to 2.3, 2.4 times 1 year forward price to book. But we feel that post this capital infusion, obviously there will be a reduction in the cost of fund, and that should aid in terms of margin expansion. And overall, if you look at the category to which Shriram Finance is catering to, there we feel that a credit growth of 14 to 15% is highly likely. Although in short term it may consolidate for some time, maybe buy on dip is the right strategy. What we feel is that the fair value of the business is closer to 950 rupees if somebody has got an investment horizon of 12 to 15 months.
Okay, Sunny, we'll leave it at that. Thank you so much for joining in. We wish you a very happy new year as well if we don't speak again. But on that note, we're going to take a short break. Don't go anywhere. When we return, we'll get you excerpts from an exclusive interview with Jeet Adani of Adani Airports. So stay tuned.
10% higher on Ola Electric, 10% higher on Grow, and a lot of these stocks doing extremely well, even as the Nifty Bank has come off the highs of trade. For a brief period, it moved into the red as well. So the market not sustaining at higher levels, closer to the 20-day moving average for both the Nifty as well as the Nifty Bank. But let's get in an exclusive conversation that CNBC-TV18 Shireen Bhan had with Jeet Adani ahead of the opening of the Navi Mumbai airport on December 25th. He says that this aero sector will be about 10% of the overall revenue of the group in the next 10 years, and non-aero business will be 40 to 50%.
Both in terms of the aeronautic revenue as well as the non-aero fee, how do you see that mix changing over the few years, next few years?
Right now, at a platform, we are 50-50. Mumbai is slightly higher. It's about 60% non-aero, 40% aero. We see that over the next 10 years, aero will be 10% of the overall revenue.
Really?
Yeah. 40% to 50% will be non-aero, and another 40 odd percent would come from city development. Yeah.
Okay, from city development.
City side development. Yeah.
So you're saying that the actual aero operations are going to be down to just about 10% of revenue?
It's the most critical part, but it's not going to be the most
revenue generating
part. I mean, it still will be, but in the larger scheme of things, the weightage will be less.
And when you talk about city development, lay out the roadmap for us, what we're talking about.
Oh, absolutely. So across our existing portfolio, we have a pipeline of 400 to 500 million square feet of development. I wouldn't say over a certain period of years because we time it as per market. In the first phase, we are doing about 22 million construction, 14.5 million leasable area. Across Mumbai, Navi Mumbai, Ahmedabad, Lucknow, and Jaipur. And in terms of product, we are focusing on hospitality, hospitality-led retail, hospitality-led commercial and office, and hospitality-led entertainment. So in Navi Mumbai, we are doing about ultimately 15 hotels across 5-star, 4-star, 3-star, and sort of transit hotels. We're doing actually more than 15. We're doing an arena that can house 25,000 people coming in. Because again, because of the connectivity of this place, it's super easy for people to come in and out, and it's just a perfect place. We're doing upwards of 7-8 million square feet of office space over here. A massive retail mall, which will start off as one of India's first outlet malls, which is a concept that doesn't exist here.
Yes.
And then eventually transition as the area picks up into a high street mall.
And by when do you expect all of this to happen?
That's what I was talking about. The first phase of 14 million is coming online in 29-30.
Okay, 29-30.
Some flashes at the bottom of your screen just a few minutes earlier. Piramal Finance is looking to sell its entire 14.7% stake in Shriram Life Insurance, and it will be doing that for a consideration of 600 crores with Sanlam Emerging Markets Mauritius. The transaction will close by the end of the March quarter, and it is in line with their plans of monetizing their non-core assets. And the contribution of the company was only not very negligible. It was only in the form of dividend received. So monetizing non-core assets is Piramal Finance selling their entire 14.5% stake in the life insurance entity to Sanlam Emerging Markets. Take a leave on this edition of Trading Hour. From Mangalam, Ritu and me, thank you for watching. Halftime report on the other side.